to a session, probably will find it quite useful this time. Now, we have already introduced you to various options, and we already introduced you to call option, put option, then also the combinations of options like a spread. Then we have also introduced you to straddle, strangle, bull call spread, and various other spread options also. And we have also highlighted at various points of time regarding the advantages of doing a spread because of the margin requirements and also because of the limited losses that it may have. So all these things have been discussed in detail. So in this session as well as in coming sessions, we will highlight some finer points as far as the option trading is concerned. Now, the reason why that we are normally get into option, now we are just only going to discuss this time. First is going to be of a buying of an option, and then one more strategy. So this is what we have in mind today. Now, the reason why we go for an option is that generally we are little less risk prone, right? So I think particularly if it is overnight positions. So we don't want to take too much of a risk. So in futures, one is the risk, because in case if there is a collapse in the market, then our stop losses will get triggered, or sometimes we may not be even able to put a proper stop loss. So that is the reason why we go for an option. It's a less risk prone. Second thing is that the premium that you pay is definitely lower than, depending on which strike you choose, the premium versus futures margin. I think this is a very important reason, because in futures you have both the normal exposure margin plus you have the MTMs, right? So you just would like to avoid a futures position because of the entailment of the higher margin. Mostly in futures, it will, for whether it is index or for stocks, it will all be upwards of the region of 1,25,000 or even more, even for one contract. So this is another reason why one is a less risk prone, and second is the premium versus the futures margin, right? But we have also highlighted that what are the advantages of an option, like these are the advantages of the option. And what is the disadvantage of an option? The disadvantage of an option is the normal time decay you have, right? So the time decay that you have probably is what you would like to ensure that you don't get much into a time decay of an option. So this is where the problem comes as far as option is concerned. And of course, the other reason is that probably a swing in volatility. I think this is another issue there. Okay, so these are the issues that you face: time decay and volatility. Let us say some other volatility itself also a few percentage points are able to manage in your profit loss account. The time decay is what is really killing, and what type of time decay that you wish to choose is most important, because the entire option, when you go for it, let us say you have decided that you want to go for an option because you're conservative, you just want it to be less risk prone. At the same time, the outlay of funds that you would like to keep it is less. And third thing is you would like to get a higher return on the margin. For these reasons, you're simply selecting an option. Now, so in that particular case, which option then you have to select? So now you come to a decision that you're going to choose a call option. Let us say the market is going up, so the trend is up. So whether it is in a stock or index, whether it could be Nifty, Bank Nifty, or any other stock, you have decided that you want to be long in the market. So the alternate to futures is you're going to buy a call option. So this also you have decided. So this is the buy call option you have decided. Now, which strike that you would like to choose and which maturity you would like to choose. These are two important factors. So the one is the maturity and another is the strike, right? Then the quantity. All these things are important. Now, the reason why we are choosing a particular maturity, strike and quantity is, in the case of maturity, normally we have also seen that nearby options expire quite fast, particularly at the money nearby option expire very fast. Let us say you are now, the nearest option is on for 14th, and for 14th the time decay will be very high because it is going to expire in another 3 days time. So whatever at the money option right now is, the decay is going to be fast. So for example, let us go for an example now. Say this is an NSE site, so this is in white background, so I will read it out for you. So let's select the 14th date. 14th, if you look at 14th now, market is closer to 14,450 or so, right? So 14,450 is going at 108 rupees. So it's 14,450 is 108 rupees. Yes, this is 14,450. This is almost at the money. It's 108 rupees. So this is for only for 3 days. This is only for 3 days, right? So this is the Nifty spot index. So I think because of 3 days, so we have to look at the spot, and the spot is 14,484. Okay. This is at 14,484. Okay. So almost you are paying 108 minus 34. So you are paying something like 74 rupees as the time value. Now we have removed the intrinsic value of 14,484 is the present spot value. 14,450 is a strike that you have chosen. So 34 rupees is there already. So we remove the 34 rupees from the option strike and premium. So the difference that we get is 74 rupees. The 74 rupees is going to decay within 3 days. That means on an average it's going to be 25 rupees per day. On average it's going to be 25 rupees per day. Probably one day it's going to be less, second day it's going to be more, and third day it's going to be the greatest. So this is going to be the time decay that you are going to face as far as option is concerned. It's for the nearby. Slightly, if you look at the far period, which is the 28th of this month, you will have for 14,450. $14,450 is around 259 rupees. 259, again we remove the futures price is going at 14,510 approximately. So we will remove something like 14,450. So we will remove 50-60 rupees from this. So approximately 200 rupees, let us say 200 rupees approximately is the time value that you are going to pay. So for 28th maturity, which is 17 days from here, you are going to pay something like 200 rupees. Okay, so this will work out something like 11 to 12 rupees. 12 rupees. Right, it's 11 rupees approximately, 11 to 12 rupees. So which is almost half of the present time decay, which is going to expire within 14. So here the time decay is comparatively less, right? Almost half of the 14th expiry. So probably, if the market stagnates a little bit, then the amount of money that you're going to lose for the 14th is going to be higher than what you're going to lose for the time value for the 28th. So having taken this, now let us say this is going, now the price is going at something like 225 rupees. The futures value is approximately 14,480 to 14,500 levels. So in case of one futures you want to buy, you will pay 1,25,000 rupees for approximately as a margin, plus any chance of a bigger problem you will lose a lot. Third thing is the MTMs also have to be paid. But here if you are paying 200, approximately 250 rupees or so, so you pay 75 into 250. Now when you are buying, when you want to have something which is very similar to the futures, then for at the money you have to buy 2 contracts to match one future contract, right? So 75 into 250 you have to multiply into 2, so you will pay something like 37,500 rupees for 2 contracts. For 2 contracts you will pay 37,500 as against 1.25 lakhs or so as far as futures is concerned. So this is going to be considerably a very low thing. Okay. So normally the second requirement, that you need a premium payment which is far lower than the futures, this one has been met with this. Okay. So to that extent you are happy about it, and the market climbs up, then the 2 contracts of this call option at present will be equal to 1 quantity of futures. For example, Now let us say the market rallies to 15,000 levels. So from the present level, approximately in futures, from 14,500 to 15,000, you will get 500 rupees, right? Here also, what you are paying 14,450 plus approximately at 200 to 250 you are paying. So that becomes, the average will become something like 14,700. So you will have 300 into 2 will be 600 rupees profit. So here, because as the rally takes place, these two contracts will become more than one contract of futures as the rally increases beyond certain levels. So that we will now keep it aside. So here you are able to get the two contracts of Nifty call option to match one contract of futures price. So to that extent, you have put in a lower margin, but you are getting a return which is similar to or better than futures. So your return on investment is going to be high. So it is definitely a much better thing to take this particular option compared to the future. So that is one thing that we have to look at from that perspective. I think the call option is definitely looks to be a better alternative compared to futures. Now, the same time, we should not get completely this one. That is, we should not keep on doing a futures the option. Call option and waste money also, right? So waste money also, that is also very important, because you feel that if the market is going to fall, if it only falls by 200-300 points, if it is going to fall only by 200-300 points, if you are not active in removing the options, that if you are not following this actively, then in the case of an option you lose 500 rupees. But whereas in the case of a futures, you might have lost only 200 rupees in a less significant move. Let us say from 14,450, futures does as a fall only to 14,250, let us say. So you lose only 200 points here. But whereas in the case of an option, you would have lost 250 into 2 because you would have paid 250 rupees premium. So 500. So as against 200, you might have lost a little more. So you need to be a little proactive to ensure that you get a profile, payoff profile, which is always similar to the futures. So what you should do is, you should be, if you just want to reduce your margin, and that is your real reason, and probably you want to be saved, your skin to be saved in the case of a very steep fall, then you should always have two contracts of call to match one call of futures, but always very closer to the strike price, very closer to the present futures price or the spot price. So to that extent, you will be in a position to match your payoff profile almost with respect to the futures. So you will have lesser margin and a payoff profile similar to the futures by always having a strike very closer to the present futures price. So if it is tomorrow, if it is going to be 14,500, 550, then in that case, the market continues to rally, then in that case you can be a little passive and keep that 14,450 itself, because the climb will get you a much higher profit because you have got more contracts. But in the event the market is static or it keeps falling, then in that case you should move your futures call option strike along with the futures price. Suppose if the futures falls down by 100 rupees, 14,450 to 14,350, then in that case you should bring down your call option strike also from 14,450 to 14,350, which means you need to book a loss of 14,450 call option and then now buy the 14,350. So if the price falls below the present futures price at which you initiated the trade, then in that case you should keep rolling over your call option to the lower side of the strike. But in case if the price keeps continue to climb, then in that case you can have a more profit by keeping the original strike itself intact, like 14,450. You can just keep 14,450 and keep riding it, and probably that can be a big. For example, let us say the market rallies by 1,000 points. That is what has happened in the last couple of months. From the month close, the rally has been approximately 1,000 points. So if this is the case, let us say the market rallies by 700 points from here. 700 minus 250, 450. 450 into 2, you would have paid 900 points you would have got. Whereas in the case of a futures, maybe you would have got only 700 points. So there is a chance that probably the profit can increase by keeping the same number of contracts in the market which is climbing itself, which is climbing higher. So to that extent, you always try, if you are going for at the money option, which is the strike which is closer to the futures price, then you always do two contracts as against one contract of futures. So instead of wasting, or I wouldn't say waste, but instead of putting money of in margin and then an MTM for one futures contract, you please trade yourself with two contracts of the call option for a strike which is very closer to the futures price. And if it falls lower, if the futures falls lower from this level, you just keep rolling your position to a lower level. So that is what probably you should attempt to do that, which will give you some quite a good profit levels. So now, as against this, there is another thing called in the money option and out of the money option. And I will try to go first for the out of the money option, because that's normally preferred by a lot of investors, mainly because of its lower cost when compared to at the money. As far as Nifty is concerned, mainly because one is it's far off, and because of some volatility pattern. No, I don't want to go into the technicalities of it. In the case of a Nifty call option, the higher strike price goes with some lower volatility, which means so the net premium that you pay for those is much lower when effectively compared to the at the money option. Just to give an illustration. Now, let us say I told you that you buy in the case of one futures, you buy two, instead of this you buy two call contracts of at the money. Okay, that is what we have said. Now let's look at the call money. Now this 14,450. So you want to ensure that whether you want to go for one call option of this particular strike, or for which you are paying a premium, which could be some 250 rupees or so, or you want to go for some other option strike, so that it gets you the same profit like one contract of call option which are of 14,450, but for a much lower premium. So let us look at what we looked at it. I will just give you the last couple of days or 1 week statistics. Now, on 5th of January, futures price was 14,216. 14,200 call option value on that day was 272. Okay. 14,700 call and 14,800 call. This is all out of the money. Okay. So 14,700 call was 70 and this is 50. This is 70, this is 50. Normally what happens is, what you should do is approximately, this is as a thumb rule, because I'm not going into the portion of the calculator to calculate the delta and other things, which we have had some session before. Today I'm not going into all the using the calculators to determine the delta, but I'm just giving us a thumb rule. Okay. Now, whenever you have an option price, this is 272 rupees. This is at the money, right? Because this is 14,260 is the futures, 14,200 is the nearest strike, so we can call it as at the money. On that day, for the 28th of January, for the expiry is 28th, right? So 28th January. Okay, the price was 272. Now, approximately you multiply this option price into 2, which is 550 points, 550 to 600 points. So at that time, if you look at it, this particular one, okay, this particular strike will give you a profile which is similar to 14,200. This one contract will be equal to 3 contracts of this. That is, one contract of 14,200 payoff profile will be equivalent to 3 contracts of 14,800 profile if managed in a proactive manner. I'm not saying that, excuse me, that under certain circumstances it may not, but in most cases, if the market is climbing higher, you will have a payoff profile which is very similar. That is, 14,200 call option and 14,800 call option can have some sort of a payoff profile above 14,800. For example, let us say it goes to 15,000. It goes to 15,000. So what is it, the profit that you get? 14,800 to 15,000. You get 200 rupees profit. You have paid a premium which is 50 rupees. So 150 rupees. Now you are getting 3 contracts you are doing. Instead of doing one contract of 14,200, you are getting 450 rupees. If you have done a 14,200 call, you would have got what, 800 rupees minus 250, 272, right? Or 250 rupees, let us say for illustration, you would have got 550 rupees. You would have got 550 rupees. So, above 15,000 and above, you will get more profits in this because you have got more contracts. More contracts. You may argue that below 14,800, this will expire, but this will have some profit. 14,200 plus 300, 14,500. So between 14,500 and 14,800, you will get a profit, right? So that's what I'm saying, that as the market situation changes, what you should do is that you should always have, because the reason why we are going for 3 contracts instead of 1 contract of this is, this is 272 rupees. In case if the market falls, how much you will lose? You will lose 272 into 75, approximately 20,000 rupees or so you will lose. Now in this case, 50 into 3 contracts of this instead of this, it's going to be 150. So 272 here, this is going to be 150, approximately only half of this. So your amount of premium that you're going to pay is even going to come much lower. So the premium that you're going to pay is even going to be much lower. So even for a 10,000 rupees contract, 10,000 rupees, you can have something like instead of having one at the money call, which would have cost you 20,000 rupees, for 10,000 rupees, you could have had 3 contracts of 14,800. Okay. But as the circumstances changes, you need to ensure that this particular strike matches with the at the money value. Now, whatever the at the money option price is, that into 2 approximately, okay, that into 2 approximately should match 3 contracts. For example, let us say I'm just saying for say on the same date on that is on 7th for a 14th option, for a 14th, that is 1 week contract. That time the futures was 14,197. Okay, so 14,200 call was going at 120 rupees on that day. Was going at 120 rupees. So 14,400 call, okay, and 14,400 call was going at 39 rupees. So what you should do is for 3 contracts, you should do it approximately into 2 times. Into approximately 2 times, so 250. So 14,450 call is what you would have had at that point of time. 14,450 call is what you would have had at this. So instead of this, you would have gone for 3 contracts of 14,450. Instead of 3 contracts, this you would have gone for 14,450. Maybe that day you might have paid 14,400 was 39. So 14,450 could have been something like 20 rupees or so. It could have been just 20 rupees or so is possible. Okay. So 20 rupees you would have paid there. And now let us say what is the 14,450 call right now for the 14th. So 14,200 call right now for 14 is going at 275. So you would have made 150 rupees approximately for profit, right? So 14,450 call is going at 108. That time you would have paid, assuming you had paid even 25 rupees. Assuming instead of, because 14,400 that time was 39, this you would have paid, let us say, 25 rupees at that point of time. So now this is 108. So 108 minus 25, okay, approximately let us say it's going to be 80 rupees. Let us say it is 80 rupees. You would have done 3 times of that, because of 250 rupees, you would have done 3 times of this. So you would have got 240 rupees profit, which is 240 rupees, whereas this 120 rupees are still given only 150, 155 rupees. Right? Assuming the market had fallen, it had been static or the market had gone down significantly, then in that case, what would have happened? You would have made a loss, correct? The loss would have been 3 into 25 or whatever it is. So it could have been only 75 rupees as against 120 rupees which you paid as far as the call of there is concerned. So the number of contracts that you have for out of money can be some value, multiplication value into the at the money contract, okay, which can give you much higher profits, okay, if the market climbs further. So what is that particular strike at the money, out of the money call that you should have? Approximately you should look at something like whatever the futures, whatever the option price is at near the at the money strike. Okay, that is option price which is closest to the futures price. If the option price is 100 rupees, you should let's look at 200 to 250 rupees from that as a place where probably you can look at the option price for a near month, for the near week, because that it will be like that. Suppose if the price is around 250 rupees, which is for the full month, then in that case you should look something like it will be approximately 600 points initially to start with. So what was 600 points at the point of time? When it comes down to 1 week, there is a chance that it would have even come to 250 points, very closer to 250 points. So now probably you might have add that the option price from there, probably from 600 points earlier, you might have just cut it off and put it closer to the 14,250 levels or so. So even then probably the profit will be much higher, because whatever that you cut there and put it at a lower level, probably would still be making some profits here when the market climbs. So the amount of time decay that you have in out of the money option is definitely lower compared to that. Is what we are trying to explain. Now let us say here through the option. Now let us say what is the time decay, what is the decay that you get? Here you get 120 rupees. 120 rupees, right? Now when I go for 3 times of this, which could be 25 rupees or so, it could be 75 rupees, right? So the decay, total decay that I'm going to expect is 75 rupees, whereas this particular is going to be 120 rupees. So even 3 contracts of this is going to have a much farther lower decay than this particular value, right? So probably you are looking at a much better profit scenario in the out of the money option. Only thing is you should always compare, because some sort of a comparison or a benchmark is always important. Otherwise you will not know against what you are performing. You should always compare that instead of going for the future. What if if I go for the call? What is it that I am saving out of it, and what is the disadvantage I am facing? How I should look at it continuously. The premium advantage, the comfort that maximum loss is going to be restricted to this. Second thing is that when you are buying 2 calls instead of 1 futures contract, when the market climbs up significantly, you get a higher profit. So the disadvantage is the market is static or falls a little lower from here. Probably the futures would have been much better. So if the market is going to fall, we should keep on rolling it over to the nearest futures value. From there can be a much better climb. So this is what you should keep always, because in a bull market, if there is a fall, okay, it will keep going up. So if it's a bear market, of course you are not going to be a buyer of a call option, you are going to be a buyer of a put option, right? So technically you are not going to be. Only thing is that even if you are in a bull market, there can be some correction for a day or two, which we saw a couple of days back also, when there was a 500-600 points of a fall from 13,750 to 31,150. So these things happen of 500-600 points suddenly, or 200 points happen suddenly, right? So in those times of fall of 200 points or 300 points, you should be in a position to keep rolling over that particular at the money strike to the nearest. Suppose if it is 14,600, if it falls from 14,600 to 14,400, okay, from 14,600, let us say it falls to 14,400, then in that case you should now rotate it, bring it back from 14,600, you should bring it down to 14,400. So when the market goes up again, probably you will make a good amount of profit there. So you always keep making your profit based on that, okay, and then keep rolling it over whenever the futures fall, okay, so that again you can make a profit from that particular level. So this type of technique, if you adopt, probably you will pay less amount of margin, and the chances of your profit will be quite high, because there is always a movement of 100-200 points which keeps happening in the market, right? Even if not, so there will always be tomorrow it could be another 100 points, another 100 points. So it only keeps moving there, right? So to that extent you will have the advantage. And of course you can also choose that in a market like this, you can always choose that in a climbing market you keep the initial contracts which you have done as anchor it, and so that when it goes up you keep making profit, okay. So now this is the advantage of doing out of the money option, because the time decay here you are paying is lower than the time decay that you are paying for at the money option. So the chances, if the market climbs up, then the chances of you making much higher profit in out of the money option is greater than what you're going to do as far as the at the money option. One. And second thing, if the prices fall, then in that case, you're going to make less loss in the case of out of the money option when in case of at the money option. So what type of thing you're going to you are to choose will depend on the circumstances prevailing at a point of time, because the situation now is that market is in very deep rally, and that has been happening this entire 1 year time frame since last December. We have not seen any sideways motion at all, except for a few days. There was a big fall, there was a big rise, okay, and we have not seen any big, just going 100 points up, 100 points down, 100 points up. So we have not seen such a movement. So the present situation more or less is dictated one way or the other the trend, okay, and so that means very clearly that you can, at this point of time, you can always choose a slightly out of the money call option and try to do more contracts than what probably you can do for at the money option. So this is one there is avenue that is left for you. Second thing is that let us say you want to go one step further in a climbing market. You don't want to pay even that 40-50 rupees premium that we have shown here. So let us say even on this particular day, this is 39 40 rupees. This is 39 rupees. 14,400 option was 39 rupees. So let us say you take a view like this, that 14,400 market is 14,200. So 14,400, right? So what you do is that you take 14,400, 39 rupees, right? So you also sell a 14,200, 14,100 put spread, and you will get something like 40 rupees at that point of time. Okay. So what happened is that from 14,400, you have not even paid the premium there. Okay. You have not even paid the premium. Okay. So when the market rallies, you will have a good amount of profit coming there. So let us look at from 14,200. Today it has rallied by 284 points. It has rallied by 284 points, right? Now suppose if you have done this particular strategy, what is the benefit that you would have got? This 14,200 to 14,100 today may have no value for 14. We'll leave it there. So what is the 14,400 value? Okay. For 14th. Now 14,400 value is 136. This is 136. Right? So overall, what futures is rallied by 284. So that means probably you should have done two contracts of this. You should have done two contracts of this, right? And it is perfectly acceptable to do that two contracts, because the reason I'm saying is this. Now, let us say if the market, let us say 14,200, it falls below 14,000. Okay. In futures, you will have unlimited loss and probably a 200 rupees here. Okay. In the case of this particular structure which we done, since we did two contracts compared to one contract of this, so 14,200 to 14,100. So the maximum loss here is going to be restricted to 200 rupees. Maximum loss here that is going to be restricted is going to be 200 rupees here, right? Now, even on the day, particularly if it's going to be an expiry day also, if it comes closer to 14,100, the value will be still only approximately, this will be around 50, 55 rupees or so, and the loss will be equal to the futures. So nothing to worry about it. If it is going to be 200 points down, then in that case, this loss is going to be the same as the futures thing. If it is going to be even less than 200, the futures is going to make more loss. To a very large extent, this is a very, very good structure. And let us say between 14,200 to 14,400, maybe this one might not have made money. But the question is that whenever there's a rally that is taking place, and you're done two contracts, right? You're done two contracts. So even if it has rallied as taken place to 14,400, even in the last day, the 14,400 will be carrying a value of 30 to 40 rupees approximately, when it's very closer to that. you'll get some 80 rupees or 90 rupees because you've done 2 contracts, whereas this would have, might have generated some 200 rupees profit. But whereas right now in the present circumstances, this is generating the same profit. If you've done 2 contracts, this is generating the same profit. Let us say the market climbs by another 50 points or so. The futures will be having only 50 points profit, but whereas this will be giving 100 points profit. This will be giving much more higher than the futures profit. So in a fast climbing market, I think what probably we should do is that we should adopt this particular type of strategy. Probably instead of going for 14,400, you could have gone for 14,300. Probably the profit would have been more, and probably you would have done slightly lesser number of this one, because 14,300, I think instead of 14,200, you could have done 14,300. And that would have been, instead of 120, maybe that there it would have been, I think 14,300 could have been 70 rupees or so. It could have been 70 rupees or so on that day. And this probably, for getting that 70 rupees, you might have done 1.5 times of this. You might have done 1.5 times of this. If that be the case, today what is happening at 14,300, let's look at the value. 14,300 right now is going at 213 rupees. So 213 into, so 213 approximately, if you have done 1.5 times of that, you will be approximately plus 300 plus. That is what right now the profit as far as the futures is concerned. It's approximately that. So you would have done 1.5 times of this. You would have got. So you could have done a 14,300 on that side, and probably this side you could have done 14,200, 14,100, 1.5 times. Right? You could have done that, or probably you would have done even one time of this and 1.5 times of this. Okay, in order to get this. And today you would not have paid any premium. Now this is going something like 214 rupees. So that would have been at 14,200 to 14,485. This is going at 285 rupees. But from now onwards, whatever that you get, probably you'll have a good, decent profit coming up. So there may be some small this one, but still this would have been worthwhile to trade. But instead of doing what you would have done is 1.5 times, or you could have done something like 1.2, 1.3 times of this and done this particular trade. So it all depends on how you view the market. So something getting very closer to what probably the futures price is, and not having much of a loss when even in compared to the futures trade. So I think based on this risk reward payoff profile, you can choose contracts like this. Now also what happens is 14,800. Now I will show you the illustration as far as the 14,000 on I told you that on 5th of this month we have taken 14,800 at around 50 rupees, and 14,200 call at the time was 272. So let us look at what the present price is. If you have done one contract of this and 3 contracts of this, okay, so what is the difference right now? Now 14,200 is 430 approximately last price, and 14,800 is 98, and 14,200 is 429. Okay. So this is 272 has become 429, and this has become 98. Okay. Now what is this profit? This is approximately 157 rupees. 157, right, for one contract. Here what is the profit? 48. Into 3 times, you would have done 3 times, right? So approximately this is the same. 3 8 are 24, 3 4 are 20, so 144 rupees. But what is the outlay here? It is only 150 rupees compared to 272. But now having got up to there, from here, if the market continues to rally, the profit that you're going to get here will be more than the profit that you're likely to get from this, right? Because you've got 3 contracts of this. So at some stage there, if it rallies to 14.6, 14.7, the chances of your profit here will be higher than the chance of a profit here. Okay. So if you want this 50 rupees also to be recovered, then you could have easily done that time itself 14.2 to 14,100. You could have done, you could have got for 50 rupees there by doing a put option there. 14.2 to 14.1, approximately 50 rupees you would have got. It would have nullified this. It would have nullified this. So what is the profit that you may be getting right now? You will be getting 48 of this. Probably at this place you will be getting some, rallied by 300 points. So maybe this would have become 20 rupees or so. So you would have got 30 rupees or so profit. So 30 plus 48, you would have got 78 rupees. So you could have just even done 2 contracts and left it. You could have just done 2 contracts and left it and add a maximum loss which could be 200 rupees, which could have had a maximum loss which would have been just only 200 rupees because you would have done only 2 contracts of that, right? But as against probably 272 rupees or so here. Okay. So that way, you can do whatever way that probably you want to do that, you can do that. And just look at the out of the money as even as a replacement. Now in this case also, we have done this with very, very less now, no premium outlay. In this case, by doing a put option also, and the sales put option also, in order to compensate for the premium out of the money call. No premium outlay. So maximum margin that you would have paid is something like 17,000 rupees or so is for 1 contract. And for 2 contracts, maybe you would have paid some 34,000 rupees or so as a margin. Okay. So that's the maximum that you're going to pay. And here also, if you want to do this also, you would have paid 300 approximately in start of 20 to 23,000 rupees or so you would have paid. But probably there's chances of that you would have slightly slipped more is higher, right? So here, the question is you're going to get 2 contracts of that, and so in case if the market multiplies itself, then you get a higher chance of making more profit because from tomorrow onwards, when it starts going up, you will get a much higher profit potential there. Now, at the near time also I've told you, so just give to take one strategy forward for this week itself. So let us look at the 14th one. So it's close to 14,500, right? So 14,500 option is going at 75 rupees. Is going at 75 rupees. So you are expecting the market to do well. So 14,500 to 14,400, you're getting something like 113 minus 72 is around 41 rupees. And this is 75 rupees. So 41 rupees you're getting there. So what you do is that so 14,500 you buy 75, 14,500 to 14,400 you sell for 42 rupees. 42 rupees, and probably you can even put in into 1.5 times. So this will approximately come 62 rupees, and this will nullify this premium almost. So when it starts to rally above 14,500, it will look as if it is the futures that you are holding, but you are having much lower. There is no premium that is paid. You have paid 1.5 times of this thing, which so it will come only to some 20,000 rupees or so at the maximum margin, and no premium pay, and you have a payoff which is very similar to the futures. Because if the market comes down also, the chances that you will have on the last day also, if it is going to be below 150 rupees in the case of the futures, this will be much better. This will be much better. So I think you have a very high chance by doing all these things. So always concentrate of how to get over the futures by having less margin, and which strike and selection of strike we should take and what combination we should do. I've highlighted just only out of the money option. I've also highlighted that out of the money option can be neutralized with a sell put option. And we have explained for two different maturities, one for this maturity, one for 28th maturity, and one for 14th maturity. We have also highlighted what probably we can do with the at the money option. In the money option, normally will itself by itself will be like a futures, but in case if the market falls down, and in that case, the amount of loss that you are making in the case of your futures, I think that will be equal to the loss of premium that you are paying for slightly deep in the money. So instead of going for that, you can go for a combination like this. Okay. So this is where we stand, and today time is 7:45. So please, tomorrow also we will have a session, and looking forward for another day of interesting session of how to use simple moving averages itself to locate intraday trades as well as position trades, and get yourself very closer to the bottom. Okay, bottom pick or top selling. Okay, so please attend tomorrow also. Thank you very much, and if you have any questions, please ask now. Thank you very much. So basically, what we try to explain this class is, can at the money option be a substitute for futures? Then how many contracts we should buy? Then similarly, instead of even going for at the money call option, whether out of the money option is more beneficial. If that be the beneficial, then for how many contracts of out of the money you have to go for one contract of at the money option. Third thing is that how do you neutralize the premium without and making yourself as equal as of the futures without paying much for margin. So these are what we try to highlight, and hope we have been able to explain to you properly in this. Thank you very much for your participation. Hope to see you again tomorrow. Thank you very much. Stay safe.